AI mania is taking hold again, and it's taking us to new all-time highs. Chip makers are soaring, and it's exactly the catalyst we needed to go ahead and break this 5,000 resistance zone. So what normally happens next? Let's look at the supporting evidence and build a game plan for next week. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and financial markets. My name is Chase. Guys, if you like this video, hit that subscribe button, like this video, and if you watch until the end, I have some trade ideas for this week. Let's get into it. And this is the weekly heat map, and yeah, fairly bullish action across the board, except in consumer defensives, utilities, and energy. Definitely more risk on sentiment, although healthcare was a bit up, but that's because they're growing earnings over the next 2 years. Out of the mega caps, Meta was the only stock that put up a red week. That being said, go look at the last 2 weeks. The stock is up like 30% plus. Pretty bullish action in semiconductors. Nvidia still the king of this market, and a pretty green day in consumer cyclicals. I think retail stocks are really seeing a huge bid up. Look at Starbucks, travel, Chipotle. They reported earnings, reported really good earnings. Yeah, we're seeing just retail stocks fly, and that's really like risk on. If people are catering to their wants instead of their needs, you know the economy is doing really good and the consumer is hanging in there. Now let's have a look at the chart of the S&P 500. Now kicking things off, we're going to look at the monthly chart of the S&P 500, and I do want to mark out two very key levels. This level right here and this level right here. Now this level is the October low, and this level right here is the June-July high in 2023, and they do mark very key and pivotal points. Now looking at this is the monthly chart. Now February hasn't closed obviously, but we are trading at the high of February right here. Looking at the January monthly candle, you can see that dip buyers stepped in right at this wick right there and took us all the way up through the low into February, where we are currently trading at the highs, and that's currently above the 2021 highs that we see right here. Now this trend is still intact. We can see we made a low here, higher low, and there hasn't been a higher low yet, but we are trading at the highs. At the same time, we can see that we made a low and then a higher high, and now trading at all-time highs. And I mean, there's just no technical damage on this chart. Sure, we did have this consolidation right here, but then you could actually see that we made resistance, then we broke above it, resistance turned into support right here, and then we moved higher. At the same time, this was absolutely key that we did hold, because it was this huge structure base. And if we do pull back, I want to look at, this 45.50 area right here for pullbacks, looking for buy side support to 5100, 5200. But guys, in terms of going back to the 4170 area, it's not even a question right now. We first would need to test the waters right here, and that's because we made a huge resistance zone right here, resistance, and then resistance does turn into support. So unless we actually break this very key zone, if we do pull back, I'm not looking or even thinking about the 4173 area. Now it's actually very much the same situation on the weekly chart. It's looking as strong as the monthly chart, and we actually closed this week at the high, as you can see right there in February. In 14 weeks, we've only had one red week, that red week right there, and all dips were bought at that low, and it's been green ever since. And you can see that if we zoom in to these weeks right here, we have seen quite a bit of selling, but these dips are just getting bought. We can see this long wick right there, long wick right there, long wick right there. We did see a bit of sell early on in the week on Monday, but then all dips were bought, and now we're closing at the high, and this looks insanely bullish, and we welcome all weekly pullbacks to the 45.82 level. That's actually very healthy to see in a chart, and it does offer great dip buying opportunities, especially with earnings moving higher. Looking at the daily chart, and it's very much the same situation for the S&P 500 daily chart, although you can then see the nuance in the pullbacks we've had right here. We did form a bit of a range at this point right here, but the second we made this low and then didn't break the low, moved higher, broke above, that was sort of your, I guess you could say, a breakout to catch maybe 2 or 3% that we made in the S&P 500. And very similar situation. There's just no technical damage on the daily chart, and the only time we will see technical damage is if we do get a daily close, multiple daily closes below this 4173 level, and I would even go as low as 4125. It's going to be at the bottom of this range right there, sort of like the top of the October lows we saw in this area right here. That being said, everything right now is pointing to upward price action. All of these bars, even on the daily, is pretty much closing at the week's highs, at the day's highs. This is very, very bullish and very, very constructive, and a lot of it has to do with earnings. Now, I'm not going to go over the Nasdaq because it's the exact same thing like the S&P 500 on the daily, on the weekly, and even on the monthly as a whole. all. It's actually sort of the exact same structure. And that's because we know the Nasdaq 100, every single constituent is in the S&P 500, except the Nasdaq 100 is more concentrated. Now, looking at the Russell 2000, we're going to mark out some very key zones, one of them being right here, and the second one being the top of this range right here. Now, this is a very key consolidation area for the Russell, and then we do have another location right up here. Now, let's actually zoom in and look at the actual bars on the monthly chart. January was actually a red bar and pretty bearish for the Russell as a whole. However, we did make a wick right there, and buyers did step in, and we can actually see that buyers have not just stepped in, and they've actually continued into February. And a lot of this has been in the last 3 to 4 days. We've seen immense strength. Now, the current monthly bar is open for February, but it's at the high of the close where it was in January. And this is setting up for one of two things: either a rejection to move back down, and then confirmation would be a close below this line right here, or we're going to go for a breakout, and then confirmation of that breakout would be move up on the weekly, a retest, and then a move higher, breaking this high. That would be confirmation right there. And ideally, you want to break this high right there, as well as the high on the retest. What the Russell then can go do is actually go look for the high right here at the 212 level. If it is to break above, retest and go for there. But what the Russell 2000 needs to do first is actually break above this line right here and go and test these key levels before it does anything else. And until then, I would remain constructively neutral on the Russell 2000. Looking at the weekly chart, the pullback we've seen since mid-January, nearly all of those losses that we've made have actually been parred by this one weekly green bar, and that shows constructively bullish price action. At the same time, we've actually seen rates move up at the same time, and I think this is finally the market brushing off any rate concerns, saying, hey, rates are going to move higher, and that's because we're pushing rates out further. And I think the market was also a bit giddy up on the CPI revisions, which we now know were relatively unchanged. There were a few minor changes, but nothing too substantial, and so the Fed doesn't really have to alter anything in their monetary policy outlook. That being said, looking at the daily chart, and you can actually see that this pullback, most of these gains were actually parred in the last 4 days this week, 1, 2, 3, 4, and it is looking constructively bullish because we did make a high, a low. We then actually did make a lower high. That's a bit bearish, but you can see that we actually did put in a higher low. It would have been further more bearish if we actually did break below this level. We did not, and we are going to test the high of this level, and that's where we close the week. That's constructively bullish. What the Russell needs to do is just go ahead and break above, go test these highs and the other key levels that I've outlined right there and right there. That's what the Russell needs to go try to do. Maybe not this week, but before the end of February into March. Sometimes these do take a while to play out. But yes, the Russell needs to make a move right now. If it does reject and go lower, breaks this low, that's going to be very bearish, and then I would probably look to the 168 level. But for now, with the strength we're seeing in the Russell and the Russell 2000 just like brushing off the concerns we've seen in rates, I would still err on the neutral side, but this is looking a lot more bullish. And if rates do come down this week, we could see a little bit of a pop in the Russell. Now, in light of all of that, where does that leave us with trading opportunities for the week ahead in the S&P 500? Well, it's quite simple. Firstly, we do know that 5,000 is the call gamma resistance. So what we could look for is a pullback early trade on Monday into the 5,000 level, get in on longs there and look for higher price action into Tuesday, Wednesday with the pre-President's Day trade. However, if that trade does fail, and failure would be falling below the 2,000 level, what we can actually then look for is buying opportunities around this structure right here. There's also a gap that's quite significant right here, and we can see that this is pretty weak structure from a technical standpoint. So right here at the 49.60 level is where we can then look for pullbacks as well into the market. If we do get below here, that is going to spell a bit of trouble. But with the current market environment where earnings are going out, I don't think we're going to get below that. And secondly, to go as far as down here to 46.60, that's actually a 1.2% move to the downside. And I think a lot of people are going to find value, especially once this gap is closed, because we also did see buyers come in right here, So yeah, that's the game plan for next week. Either buy the 5,000 level. If it does break, we're going to buy the 49.60 level. Although we do want to be out of trade by Friday at the very minimum, start of Friday, because we are entering the window of weakness. And though we do know that post-OPEX tends to be very, very weak, especially at an index level. Now that we wrapped that up, guys, the weekend poll is currently ongoing. We have 274 votes. So what you guys need to do is go to the community tab right here on my channel on your iPhone or the desktop. Click the community tab and go and cast your vote for this week's weekend poll, and it's just the next 100 points in the S&P 500. Currently, we are neck and neck, 51% bullish, 49% bearish. We'll see how this ends up on Monday. Very, very even votes here, and lately this sentiment poll has been quite the contrarian indicator, but with it neck and neck right now, I think that might actually mean maybe we just go flat for the week. Very, very interesting. So go vote. Let's see what we finish up on Monday. Now, looking at sectors, well, we got the 4 best performing sectors. They've been the best 4 performing sectors for the year and last year. Semiconductors, software, comms, and technology, really just like the mega caps and then proxies of those mega caps. And then, everything else below the SPY actually put out a really good week. I mean, look at home construction, staples, industrials, financials. These are very, very good numbers. You take those numbers in gains every single week if they're in your portfolio and these stocks in these sectors or these sector ETFs are giving you these gains. What didn't perform so well though, I mean, look at energy, anything to do with mining metals, right? And then like commercial banking, commercial real estate and banking. Look at XLRE, KRE, GDX, part of the mining sector. So, ditching real like commodity and commoditized stocks like banks, poor balance sheet stocks, and going for more of the AI mania, high quality balance sheets, high quality businesses, expandable businesses, internationally diversified businesses. And the truth is, this is where growth is right now. Regional banks are not growing earnings. Metal and mining are barely growing earnings. Utilities are growing earnings quite significantly, but that's because they were coming off an absolute shocker year. Real estate is coming out of a lull, and so you can definitely see why stuff like healthcare, tech is up there in the best performing sectors for the week, for the year so far, and to be honest, for the last 18 months. Now guys, let's talk about earnings. We're in earnings season and actually a really big earnings week. We have Waste Management after the close, Cadence Design System, that's a big semiconductor name reporting, and then that's really it for Monday. Tuesday we have quite a lot of software names, and there's a lot of like retail focused names this week, but not necessarily like Costco or Walgreens, more like stuff like Shopify, Coca-Cola, Airbnb, Lyft, right? These are like really good proxies for the consumer and how they're holding up more in the wants department more than the needs. Look at like Hasbro. And we also have a couple of other names, stuff like Instacart, okay, Moody's as well. Pretty big day on Tuesday, and we're going to cover all of them. Wednesday, we have Barrick Gold Corp, Kraft Heinz, that's a big Buffett holding. Then we also got Oxy and Cisco after the close. Then Thursday, again, very similar to Tuesday, we got Crocs, John Deere, DraftKings, Coinbase, Roku, The Trade Desk, Applied Materials, big semiconductor name, DoorDash. They recently just got put into the Nasdaq 100. Wendy's, very much how are retailers doing, how are consumers doing, are people buying what they want versus what their needs, and then not really much going on Friday. But I actually think a very key week to gauge the strength of the economy, the consumer, and also the labor market as a whole. Now, let's look at the earnings scorecard right now. This is the S&P 500 in line or above, and we can see here that 75% of companies reporting above earnings expectations, 19% below, 6% in line, and all in all, we're looking at 81% in line or above, and that's a very good number. That's actually above the 10-year and 5-year average for the S&P 500. Now, here's the blended earnings growth. I go over this ad nauseum. S&P 500 is reporting 9% in earnings growth, 12.5% excluding energy. And let me explain what this means, right, guys? So FactSet on the 1st of January reported that the S&P 500 was reporting negative 1.7% earnings growth for the earnings period Q4 2023. Earnings have come in, and then we got a blended earnings growth of 9.9%, 12.5% excluding energy. And essentially what that means, right, is that the S&P 500 is reporting 10.3% better earnings. To put that into perspective, right, earnings has increased by 10.3% since January 1st, whereas the S&P 500 in that period has only increased 5%. So like by and large, the S&P 500 is actually 5% cheaper now than it was at the start of the year. And that's why we're rallying. That's why we're seeing this like stair step up, because price is catching up to earnings. It's how the market works. The thing is, the reason why a lot of these PE ratios haven't been filtered into the stock is because they really just wait until after the earnings season to calculate the PE. So right now you'll see PE at 20.3, but like really if we were to use like a trailing PE, I think we're probably closer to like 18.9, 19x in the S&P 500 right now. But we still have a lot of firms to report, and there's companies like Nvidia, which contribute so much earnings to the index. Earnings season looking really, really good. And we're going to see if this trend continues. Maybe we get double digit in the S&P 500 and get like excluding energy at like 14% plus. We'll see what this week brings. We have a pretty big week. We have a pretty big week of earnings. Now, that is for the S&P 500. Look at small caps right now. And small caps have been left behind in earnings. They're reporting detrimental earnings growth, whereas large caps have recovered. Small caps are only expected to make their recovery after this quarter, Q4 2023. In the first quarter of 2024, small caps are expected to report better earnings in the S&P 600 than the S&P 500, and that should continue for the rest of the year. So it's ideally you want to have exposure to both of these names or companies in these or both these indices. Don't go buy the IWM, get the S&P 600 or go look at like small cap quality ETFs. You're still getting companies at like a 16x PE that are just exceptional companies, but they're just small. There's the total addressable market is just less, and by and large they're just naturally smaller companies. So yeah, I think, you know, continued exposure to small caps as they improve earnings is going to be really, really good. And look, we're looking at like in Q4 24, 20% earnings growth in small caps. We're looking at like what, 15% for Q2, Q3, 10% what, Q1. So yeah, you know, I think now is a really good time. If you're not in small caps just yet, I think this will probably be the last time to get it before they really do re-rate higher and go and test all-time highs, especially with this earnings growth right here. That's kind of crazy when you think about it. But that being said, the profit backdrop has matured more than the GDP backdrop for small caps. So long story short, this environment is still more conducive for larger caps than it is for small caps. And so this is why it's best to just have exposure to both large caps, small caps, and even mid caps by and large. Now, where does it leave us with valuation? We kind of spoke about this already. The S&P 500 is trading at a 20.5x PE, a 1.2x PEG, and a free cash flow yield of 3.5%. Energy, the free cash flow yield is at 8.3%. Do take into consideration right now that the 10-year is sitting at what, 4.4 or 4.3% at the moment. So you would say that the S&P is slightly overvalued, and then by and large energy is undervalued, and you'd be undervalued all the way up until healthcare, comm services too. Kind of crazy. That's a huge free cash flow yield. And then information technology at a free cash flow yield level, not looking that great, but price to earnings growth undervalued on that metric, and currently trading at a 28.2x PE. So technology is quite expensive, but by and large the S&P 500 as a whole, some would say is expensive. I think it's fairly valued at 20.5x. A lot of people hate when I say that. I get mad comments, but it's what I think, is what I believe. And if you are looking for value in the S&P 500, look at financials, look at utilities, look at energy. They tend to be the cheapest, especially financials on a price to earnings growth relative to PE. But the way financials are valued with like net interest income can be a bit weird, and it's why I don't really like holding individual financial stocks. I'll more hold like ETFs for financials. That being said, I am bullish on financials and I am bullish on energy as a whole, particularly energy in 2025. Now, looking at some trades for this week, guys, I got some very interesting stuff for you here. So we're in pre-President's Day week. President's Day is not this week, week after. And you could see here that normally Monday, Tuesday, Wednesday, when the calendar year is positive, on pre-President's Day week, we can actually expect pretty bullish returns for the first 3 days. Average 0.07%, but since 2000, 1.1%, 82.76% of the time higher. So very positive hit rate right there. And then you really want to be out by Thursday, Friday. You want to get out of these trades because normally the actual options expiry day is very negative for the S&P 500. You can see here that since 1994, average return on OPEX day, negative 0.24, median negative 0.12, percentage of the time higher, only 40%. But if you actually have a look at the options at the OPEX week, it is still a fairly positive week because the first 3 days tend to be quite positive, average returns of 0.28%, but the week after tends to be very negative, negative 0.72%. And we do know that with seasonality, we can actually expect a dip after OPEX. This right here is normally OPEX. It's normally on the 11th or 12th trading day of February. So this point right here is OPEX, and then we do get sell towards the end of February. And normally it actually takes us back below the lows where we opened, where we normally see a dip early on in February. That being said, this is where we are right now. We are up about 3.2% in February. It's been a very bullish period, but don't be surprised if we do get sell side. According to seasonality and post OPEX stats, that's what we normally see in February. Now, this is the gamma exposure heat map. We got the early one thanks to Options Depth. Big shout out to him. He gave it to me early. Now we could see here, guys, that we are in fairly positive gamma below this 5100 area. Above, we actually get into negative gamma. And so what this essentially means is where we are right now is sort of around this area right here, the 50-20 area. I think we closed the week at 50-22. So we're sort of right around here, right? If we are to move lower into the start of the week, we're going to find strong strong support here at the 49.50 level, 49.60, 49.70. In fact, this entire positive gamma area will be very supportive if we do sell down. Dealers will be buying dips into here, but if we do rally upward, they'll also be selling rips into it. So there's going to be a lot of compressed volatility below the 50.90 area. The second we go above it into this negative gamma area, this is where gamma exposure is going to be exacerbated. Now, if we open the week at 520 and start rallying into this negative gamma area and we go into it, we could just see continued rallies, because in a positive gamma environment, we see dealers buy into the strength and sell into the weakness. Now, there is a resistance zone in the negative gamma pocket right here, so we could really rally, and then if we do find resistance, we could like sharply move back into this positive gamma zone. So I do expect this 5100, 5090, 5120 area on Monday. If we do get there, it's a pretty big ask to go up there. If we do get up there, we're going to see a lot of volatility. If we do break above here though, very quickly at the 5150, 5170 area, we're going to find more resistance, and again, it's going to be very like sharp, quick turns with huge amounts of volatility, and we could actually see that in the market. We've been in positive gamma for the better part of 3 months. Dealers have been buying dips, selling rips, and I do think that expanding volatility is actually healthy for the market. It's really going to help us weed out some of the weaker hands that sit in the books of the market. Looking at breadth has improved significantly. We can see here that the ADL line has actually made a new high at the same time that the S&P 500 has made a new high, and that's exactly what you want to see. Now, what we do want to see here is either continuation in the ADL line on the upside while this goes sideways or goes up. What we don't want to see is deterioration of the ADL line while this maybe travels sideways or moves even higher to that 5100 area. That's what we don't want to see. We want to see these move in lockstep. Now, looking at some trading ideas, this is Roku, guys. They report earnings on Thursday, I believe, and what we're seeing set up here is sort of like a head and shoulders pattern, and we are getting some ugly candles right here, but if we are to break above, earnings coming better than expected, we can actually look at the psychological level right here of 102, 100. There's also a gap that needs to be filled. We go ahead, hit this, we can then look at these highs right here for continued price action in the upward direction. Another trade idea I have is McDonald's. Very similar situation. We got a head right here, we got the left shoulder right here, head, right shoulder, and what we've seen is we came down, moved back up, a strong price rejection. If we continue to see pretty bearish candles into Monday, into Tuesday, into Wednesday, right, especially when we do know that the week after OPEX is pretty brutal, we can then actually look for short trades into this 282 area and then even to right here 268. And we do know that there's also a macro picture happening with McDonald's. They are going to decrease their prices across all of their stores because people have been complaining it's way too high. That's literally deflation. That's going to affect their bottom line, and this is why we might see some sell side in McDonald's, and we could even go as low as these lows right here, the October lows in McDonald's, especially if over the next couple of quarters earnings don't come in as expected. So just a couple of trade ideas there for you guys. Now, data in the week ahead, you guys can go ahead and look at this, but we have retail sales, we also have PPI, CPI, so a very big week of data, as well as some manufacturing, empire manufacturing, industrial production, housing starts. So a very big week, guys, in terms of data, in terms of earnings. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell. Cheers.